The stock market is a machine. But not of steel. Not of oil. Not of electricity. It is a machine of belief. At its core, a stock represents ownership. A share in a company. A claim on future profits. Simple in structure. Complex in behavior. When you buy a stock, you are not buying today. You are buying expectation. Expectation of growth. Expectation of revenue. Expectation of stability. Markets move not on reality, but on anticipation. If investors believe profits will rise, prices rise. If investors fear decline, prices fall. Even before anything changes. The stock market is forward-looking. It prices the future. That is why it often rises during uncertainty. If optimism outweighs fear, and falls even when current numbers look strong. If doubt spreads, the machine runs on information. Earnings reports, interest rates, economic data, geopolitical events. But information alone is not enough. Interpretation matters. Two investors can read the same report and reach opposite conclusions. Because markets are not calculators. They are aggregations of psychology. Greed, fear, hope, panic. These emotions scale. Millions of participants acting simultaneously. Algorithms amplify reactions. High-frequency trades execute in milliseconds. News travels instantly. The speed increases volatility. But the mechanism remains ancient. In the 1600s, the Dutch East India Company issued shares. Investors speculated. Prices fluctuated. Optimism expanded markets. Fear collapsed them. Centuries later, the pattern is unchanged. The Great Crash of 1929. The dot-com bubble. The 2008 financial crisis. Different triggers. Same psychology. When prices rise steadily, confidence builds. More investors enter. Momentum accelerates. Valuations stretch beyond fundamentals. This is euphoria. But euphoria blinds. Risk appears distant. Warnings are ignored. Leverage increases. Then something shifts. It may be small. A disappointing report. A policy change. A credit event. But once confidence cracks, selling begins. And selling feeds on itself. Liquidity disappears. Prices drop faster than they rose. Fear spreads quicker than optimism ever did. The machine reverses. Markets are not evil. They are mirrors. They reflect collective expectation. When society believes in expansion, markets expand. When society fears contraction, markets contract. Over long periods, markets tend to rise. Because innovation continues. Businesses adapt. Productivity improves. But short-term movement is chaotic. Speculation differs from investing. Speculation seeks quick movement. Investing seeks long-term value. The market rewards patience, but tests discipline. Those who chase momentum often buy at peaks. Those who panic often sell at bottoms. Because belief shifts at extremes. The stock market distributes capital. Successful companies receive funding. Inefficient ones lose it. In theory, this creates efficiency. In practice, human behavior distorts outcomes. Herd mentality amplifies trends. Social media accelerates hype. Narratives spread faster than analysis. In modern markets, stories move prices. A visionary founder, A new technology. A viral rumor. Belief can add billions in valuation overnight. And remove them just as quickly. Volatility is not malfunction. It is emotion quantified. The market does not promise fairness. It promises opportunity. But opportunity requires understanding. Understanding that price is not value. Understanding that trends are temporary. Understanding that belief is fragile. The stock market is not a casino. But it can feel like one. To those who do not grasp the system. At scale. It is a capital allocation engine. At human level. It is a psychological test. Patience versus impulse. Strategy versus reaction. Discipline versus fear. In the end, the machine does not think. It responds. To data. To policy. To emotion. The stock market is belief. Expressed in numbers. And numbers, when driven by emotion, can build fortunes. Or erase them. The machine keeps running. The question is, do you understand? What drives it?